Hey guys, welcome back to another video where I'm bringing some cryptocurrency news. Today's article comes from the Decrypt and what are liquidity pools, the funds that keep DeFi running. Without liquidity, financial systems grind to a halt in decentralized finance. Liquidity pools help keep things running smoothly. So yeah, you may have heard me talk about liquidity pools when I usually do my data network updates in the morning, saying how T-Fuel is being associated with some sort of liquidity pool. This article will help give you a little bit better of an explanation on what they are and how they are working and making people money. So, the world of finance runs on liquidity. Without available funds, financial systems grinds to a halt. DeFi or decentralized finance, a catch all term for financial services and products on the blockchain, is no different. DeFi activities such as lending, borrowing, or token swapping rely on smart contracts, pieces of self executing code. Users of DeFi protocols lock crypto assets into these contracts, and these are called liquidity pools, so others can use them. Liquidity pools are an innovation of the crypto industry with no immediate equivalent in traditional finance, in addition to providing a lifeline to a DeFi protocol core activity. Liquidity pools are also serve as a hotbed for investors with an appetite for high risk and high reward. Now, how do liquidity pools work? Look beyond the technical language and you'll find that the basic rationale of liquidity pools isn't intuitive. For any economic activity to happen in DeFi, there needs to be crypto, and that crypto needs to be somehow supplied, which is exactly what liquidity pools are set to do. That role is fulfilled by order books and market makers on centralized exchanges, but that's a different story. When someone sells token A to buy token B on a decentralized exchange, they rely on tokens in the A/B liquidity pool provided by the other users. When they buy B tokens, there will now be fewer B tokens in the pool and the price of B will go up. That's simply supply/demand economics. Liquidity pools are smart contracts containing locked crypto tokens that have been supplied by the platform's users. They're self executing and don't need intermediaries to make them work. They are supported by other pieces of code, such as automated market makers, AMMs, which help maintain the balance in liquidity pools through mathematical formulas. Now, why is low liquidity a problem? Low liquidity leads to high slippage, a large difference between the expected price of a token trade and the price at which it is actually executed. Low liquidity results in high slippage because token changes in a pool, as a result of a swap or any other activity, causes greater imbalances when there are so few tokens locked up in pools. When the pool is highly liquid, traders won't experience much slippage. But high slippage isn't the worst possible scenario. If there's not enough liquidity for a given trading pair, says say Ethereum to comp on all protocols, then users will be stuck with tokens they can't sell, and this is pretty much what happens with rug pulls. But it can also happen naturally if the market doesn't provide enough liquidity. Now, how much liquidity is there in DeFi? Liquidity in DeFi is typically expressed in terms of total value locked, so the TVL, which measures how much crypto is entrusted into protocols. As of April 2022, the TVL in all of DeFi was $222 billion, according to the metrics site DeFi Llama. Total value locked also helps capture the fast growth of DeFi. In early 2020, Ethereum based protocol recorded a TVL of only $1 billion. Now, why provide liquidity to a pool? For investors, liquidity provision can be lucrative. Protocols incentivize liquidity providers through token rewards. This incentive structure has given rise to crypto investment strategy known as yield farming, where users move assets across different protocols to benefit from yields before they dry up. Most liquidity pools also provide LP tokens, a sort of receipt, which can later be exchanged for rewards from the pool. Proportionate to the liquidity provided, investors can sometimes stake LP tokens on other protocols to generate even more yields. Now, beware of risks. However, liquidity pools are prone to impermanent loss, a term for when the ratio of tokens in a liquidity pool, for example, a 50-50 split of Ethereum/USDT, becomes uneven due to the significant price changes that could result in losing your invested funds. Now, who's using liquidity pools? We got 1inch, a decentralized exchange aggregator that works across multiple chains, Aave, a decentralized lending platform, and Uniswap, a decentralized exchange for swapping Ethereum-based tokens, as well as T-Bill. They are Theta Network's liquidity pool. Now, how can you add liquidity? Broadly, there are two ways of adding liquidity. If you want to add funds directly to a liquidity pool, such as the Ethereum USDC liquidity pool on SushiSwap, you will need to have equal amounts of Ethereum and USDC, which you can swap using any decentralized exchange. You generally need an equal pair of tokens because trading, borrowing, and most other DeFi activities are almost always two-sided. You exchange Ethereum for USDC, you borrow DAI against Ethereum, and so on. As a result, most protocols require liquidity providers to pledge the equivalent value of a 50-50 of two crypto assets to available pools so that a balanced pair can be maintained. Balancer has taken an innovative approach, allowing as many as 8 tokens in a liquidity pool. But there's also less cumbersome way. You can zap into a liquidity pool, adding liquidity in just one transaction through platforms like Zapper, which invented the concept in 2020. Just go to zapper.fi and connect your wallet, click pools to list the liquidity pools available for zapping in and out of, add liquidity to the pool using whatever asset you have. Zapper will exchange them into equal splits of the relevant pair, and that saves a couple of separate transactions. Now, however, Zapper doesn't list all liquidity pools on DeFi, restricting your options to the biggest ones. The future of liquidity pools. Liquidity pools operate in a competitive environment, and attracting liquidity is a tough game when investors constantly chase high yields elsewhere and take the liquidity with them. Now, Nansen, a blockchain analytics platform, found that 42% of yield farmers who provide liquidity to a pool on the launch day exit the pool within 24 hours. By the third day, 70% will be gone. To tackle this problem, known as mercenary capital, Olympus DAO has experimented with protocol-owned liquidity. Instead of setting up a liquidity pool, the protocol lets users sell their crypto into its treasury in exchange for its discounted protocol token, OHM. Users could stake the OHM for higher yields. But the model has run into similar problems. Investors who just want to cash out the token and leave for other opportunities, diminishing the confidence in the protocol's sustainability. Until DeFi solves the transactional nature of liquidity, there isn't much change on the horizon for liquidity pools. So yeah, that's pretty much an explanation of what they are, what the risks are, how do you do it. Like again, like this was an educational article for you for who are like still like early in the crypto space and you're trying to find other ways to invest your cryptos instead of relying on the volatility of the token. Like you want to be able to make some income like outside of staking and running nodes out there or mining with a proof of work system. Like liquidity pools are just another way to potentially make some more money, but just make sure you do your research and that it is a secure network that you can trust. So again, like you don't want to be rug pulled, you don't want to lose your money. So just be careful out there. Always do your research, make sure something's good. And yeah, always keep in the back of your mind too, like, is it too good to be true? Then it probably is. Like that's just a saying just to be by yourself. Like you're getting like 2,000% interest. That could be too good to be true. So just be careful out there because some of those high yields are tempting, but that's how much risk you're willing to put into it. So yeah, great article. If you guys liked it, hit that thumbs up, subscribe to the channel so you do not miss a beat. And until next time, the Crypto Sherpa is out.